prices up for the fifth straight week, and they are set to post their biggest monthly gains in over a year. Right now, the price of crude oil, let's check things out, looks like WTI is at $81.35. That's up another 1%, and you can see the one-month climb, a gain of about 15% right now. For more on this, we want to bring in Jeff Currie, Goldman Sachs Global Head of Commodities Research. Jeff, look, we are talking about a big run over the last month, but we're well below where we probably thought we would be a year ago right now. What happened? Why were prices lower before, and why are they jumping at this point in July?
I mean, the biggest factor was what happened in China. Yeah, a lot of people will tell you it was expectations around Russian supply, but those were expectations. These are spot markets that have to clear today's supply and demand. The big shift was China. China, coming out of zero COVID policy, demand cratered in late fourth quarter and the earlier part of this year. It has now rebounded back up to around 15.8 million barrels per day, which is rather healthy for July. And then you combine that with the recent announcements of, more stimulus on the property side. It's taken a very pessimistic view of China and turned it into a positive view. So you can think about the weakness that we started the year with being driven by China, and a lot of the recent strength being driven on a much more positive outlook for China. But I think the other factors that are important, one, demand outside of China is holding up far better than most ever feared, particularly around concerns around a recession. And a lot of the strength recently, again, is investors coming back to the space. And then the other factor that I would put into this is what's going on the product side, because ultimately this is in-use demand. Product margins very strong, and when you look at prices, historically, the gasoline prices, the in-use prices are all sitting, moving up to very extremely high levels. That's going to put a lot of pressure on prices at the pump as we began to look forward. So, I think the real reason why we were so weak at the end of last year was driven by weakness in China, and a lot of that has shifted, and I think that's one of the big factors that's driven this. And also, let's not forget OPEC, very aggressive in the production, compliance out of Russia, compliance out of the group, very significant, which is leading to a deficit. And that's the last point I want to make here is, inventories in July are looking like they declined somewhere around 2.2 million barrels per day. That's big, and that's just reinforcing the potential for more upside.
So as a result, you're sticking with your price target for the year. What is it for Brent, $93?
Yeah, for Brent, our 12-month target is 93. But the question you ask is how much is this going to go into products? How much is this going to go into crude? So if more of it goes into crude, there's upside relative to the 93. One of the reasons why we're keeping a lid on 93 right now is that you have your starting point is higher inventories left over from the demand weakness that, earlier this year. But the second factor is interest rates. They're historically high, going back, 2-decade highs. That creates a drag on commodities, flatness of the curve. So we'll see what happens over that time period. But those are the two reasons we're keeping the cap at 93.
Really quickly, we're almost out of time, Jeff. But when you look at refining, I mean, that's been an issue, especially with the recent heat wave. I know it's brought an ExxonMobil refinery down and maybe some others as well. That's why we've seen these higher gas prices at the pump for consumers, even relative to the gains we've seen in WTI and Brent. Does that continue?
Absolutely. Because the refining kit around the world is underinvested in, so it doesn't have the upgrading capacity to turn unwanted products like naphtha into final products. And because it's running at such a high utilization rate, the probability of another outage or problems in the heat, and it could be Europe this summer, whatever it might be, the probability of those type of events are just increasing with the high utilization rates, which all stem to underinvestment. And at the core of our super cycle thesis across all commodities is this whole idea of underinvestment and the revenge of the old economy. And that's still very much alive and kicking.